This is Business Weekend.
Hi and welcome to Business Weekend. I'm Edward Boyd. Coming up on the program, the recent hacks at Medibank Private and Optus have highlighted the danger of holding too much customer data in an insecure way. Shadow Minister for the Digital Economy, Paul Fletcher, speaks to us about what happens when data turns poisonous.
My data about me, your data about you, is commercially valuable, so we need to have a policy framework so that you or I can get benefit from our data.
Swedish vehicle maker Volvo will deliver 36 electric trucks to a freight company here in Australia next year. So what's the capacity of these rigs and how far can they drive? We'll catch up with Volvo Australia's president, Martin Merrick.
We anticipate by 2030, roughly 50% of the Volvo trucks we sell will be electric.
The La Nina weather pattern has brought record rainfall to Australia, which has resulted in devastating floods across the east coast of the country. But the silver lining has been bumper seasons for Australian farmers. ABARES provides us with an update.
Another record for our gross value of production this year, or close to, around $85 billion. And a large part of that's been about the weather that we've received.
But first, the Reserve Bank raised interest rates to 3.1% this week, bringing the cash rate to its highest level in a decade. The September GDP quarter numbers were also released, showing households are continuing to spend money. So is this a challenge for the Reserve Bank, which is trying to cut spending and reduce inflation? Here's the Treasurer, Jim Chalmers.
When it comes to the Reserve Bank, obviously I don't give them free advice. They take their decisions to change interest rates independent of the government. And they've got a bit of an opportunity now in the 2 months between yesterday's meeting and the meeting in February to weigh up all of these sorts of economic developments. We are seeing the beginnings of some softening when it comes to the factors that the Reserve Bank pays the most attention to. What we really need to be focused on is the fact that the global economy is a difficult place right now. And we haven't seen the full impact of interest rate rises at home play out either, and that's why we're pretty cautious about these results.
Well, let's unpack what all of this means with Westpacs senior economist Matt Hassan, who joins me here on the set. Matt, thanks for your time today. Let's start with the Reserve Bank. They raised rates on Tuesday. Where are you expecting rates in Australia will finish up?
Look, we think there's a little bit more to go. 3 more 25 basis point moves through to the middle of next year. May, we think, will be the peak, about 3.85% for the cash rate. This week we saw the 25 basis point move and a pretty clear signal from the RBA that they expect to do more on rates. They'll still be getting some fairly poor inflation reads going ahead. They'll be getting some more testing wage growth numbers. I think it'll be mid next year when they go on pause.
The other figures that came out this week were the GDP numbers, and we saw, it was for the September quarter, but we saw consumer spending still holding up pretty well. Household consumption pretty strong in the September quarter. How much of a concern is that for the Reserve Bank?
Oh, look, they'll be anxious to see that turn, and it hasn't yet. So, what we saw in the September quarter was the end of that sort of post-COVID reopening flourish, and things have got back onto a more even footing between the Delta and non-Delta lockdown states. It's kind of old news now. What we're looking for is particularly interest rate hikes starting to bite with the household sector. Our more timely data are based off card transaction activity, which we have now up to the first week of December, is suggesting that momentum's still plugging away quite nicely. It looks like Black Friday and Cyber Week were pretty big this year around, and there hasn't been any slowdown from that off the back of rate rises. Yes, there's been some impact from higher prices. That's eroded the purchasing power of consumers. But if we're looking at for the mortgage belt to really start to tighten, that doesn't look to have happened yet. We know it'll happen. We're waiting for it to happen. The RBA will be a little bit anxious to see that happen, and really that'll be the first part to moving towards an on-hold step for policy tightening.
Yeah, the property market, it looks like it's going to come under a bit more pressure next year, with particularly the number of people on fixed rate mortgages coming off to these much higher interest rates. So what point next year do you think we're really going to start to see that hitting the market?
So we've looked pretty carefully at the forward profile of fixed rate roll-offs. It basically delays the tightening quite significantly. We get an effective tightening in terms of interest rate tightening worth about 25, 30 basis points across the whole sector through sort of June, September quarter, even on a pause in May. So, that roll-off will really start to bite in the second quarter, where we'll see quite large numbers moving off those ultra-low, sub 2% fixed rates on the much higher rates. For the property market, what we typically see through correction phases is two distinct parts of the correction. There's the part when interest rates are rising, and that's affecting buyers' ability to borrow, and you tend to see quite sharp falls in prices through that phase. Once rates go on hold, though, you often see a second phase of residual weakness. When rates are still high, but the economy is working through a significant slowdown, you may have a rise in unemployment, and you'd have some residual weakness in prices. So I think for the property market, that fixed rate roll-off is another sort of pressure point mid-year. The property market's really about the RBA cycle and when we get a clear signal that rates are likely to move lower.
And I know this week your colleague Bill Evans has put out a note basically suggesting Australia's economic growth is going to slow down next year. Just talk us through what the prediction is exactly.
So look, we expect growth to slow right back to around 1% for the consumer spending piece of growth as well. That's a per capita stalling. Essentially, the back half of next year is shaping up as very flat as things like these fixed rate roll-offs and interest rate tightening really bites hard. So it's looking like a very challenging year ahead. For now, things are still tracking quite nicely, but we've got a big rate shock to absorb in this economy over the next 12 months.
RBA put out their economic forecast last month, expecting inflation to get to 8% in December. Are you expecting inflation to peak that high? Yeah,
we're looking at something very similar, just a touch above 8% by the end of this year, coming back a bit more than the RBA currently has. We're expected to be just a touch above 4% by the end of next year. But that gives you a sense of the scale of the inflation challenge that the RBA is facing into and global central banks more generally. 2 years of such strong inflation really does run the risk of a shift in inflation psychology and a more persistent period of higher inflation, which is exactly what they're trying to avoid.
Now, next week, there's also the unemployment numbers. They're out on Thursday for the month of November. Last month, the October figures, the jobless rate dropped to 3.4%. So are we still going to see really low levels of unemployment in the economy?
Absolutely. We're really struggling to fill an enormous round of vacancies at the moment across the economy. We're basically at capacity and stretched as far as we can go. We think the unemployment rate is likely to nudge slightly lower to 3.3% next week. And it really is the unemployment rate that's the key here, because one of the things that is starting to show through in the labour force data is our external border reopening is seeing a really quick return to strong population growth. And that's showing through clearly in the working age population numbers we're getting month to month, and that'll support the employment growth numbers month to month. I think it'll be another decent 25 to 30,000 gain for November. But the key is about our capacity. If we're able to increase the supply side on the labour force and better meet those increased, that the demand is already clearly there, that'll show through first in the unemployment rate and to some extent the underemployment rate. Still not quite there. I think we're some way before we start to see these pressures ease, and that's really a key thing for the RBA medium term. Like the inflation surge we've had this year is primarily global, and we're seeing the Fed respond aggressively on that front. And that global inflation is about to dissipate significantly, if for no other reason than freight costs and energy prices have come right back down. But for the RBA, they need to ensure that the domestic inflation piece remains completely under control, so that as that comes through, inflation goes back to those really stable low 2 to 3% rates that we're targeting.
Well, just on the Fed, they hold their cash rate meeting next week. Then they've got another one at the end of January. So they've got 2 meetings before our own Reserve Bank meets at the beginning of Feb. How much pressure is this going to put on the Reserve Bank to raise interest rates in February?
Look, I think it puts a little bit of pressure in the backdrop here, because clearly there's a global inflation that requires central banks everywhere to respond to, and the Fed going hard. Some of this pressure will play out potentially around the currency. We think the Fed will start to pivot. We're looking for a 50 basis point move next week, and then January sort of stepping back to 25. So a clear signal that the tightening is starting to reach a pause. But they'll be maintaining a very hawkish rhetoric. We've seen very hawkish rhetoric already from Chair Powell and the rest of the FOMC. And that's likely to be sort of sustained over the next few months to ensure that markets don't run ahead with the idea that there's an easing about to come through. So for the RBA, that sort of maintains the urgency of needing to respond to inflation near term. There is a little bit of sort of wriggle room. We know that policy is much more potent in Australia because of the structure of our household debt being predominantly on floating rate, variable rate mortgages compared to fixed rates elsewhere. So they know they don't have to follow the Fed all the way, but the change of tack hasn't quite come to pausing, and I think they'll clearly see a need to continue moving policy into restrictive territory before they choose to pause as well.
Well, Matt Hassan, Senior Economist at Westpac, thanks so much for your time today.
You're welcome.
Well, the recent hacks at Medibank Private and Optus highlight the danger of holding too much customer data in an insecure way. This weekend, for example, all of Medibank's systems are down as it upgrades its defences. Ross Greenwood this week spoke with Paul Fletcher, the former Communications Minister and now the Shadow Minister for the Digital Economy, to ask him what happens when data, the lifeblood of so many industries, turns poisonous.
Look, you raise a very good issue, Ross. I gave a speech earlier this week where I talked about, amongst other things, the data breaches we've seen at Optus, at Medibank Private, made the point that we've seen a fair bit of this over the past few years. The Australian Parliament was hacked, Australian National University, Toll, and there have been others. And clearly that's of great concern to anybody whose personal records have been compromised. But it's also a broader problem if we believe, as I certainly do and the Coalition does, that the digital economy is key to our prosperity. Then anything which disincents people or businesses from taking advantage of the productivity and efficiency benefits of digital is a problem. So there's a host of reasons, I think, why we need to have a plan to deal with these cybersecurity challenges.
But going deeper than that, in the case of Optus or Medibank, say, for example, the government's now saying we're going to impose heavy penalties. The reality is that these breaches have occurred before such penalties regimes are going to be put in place. They could walk away literally scot-free. I just wonder about the disincentive for the companies to collect too much data, too much personal data, and literally leave it there for years just in case they need it down the track.
The Labor government said that one of their responses to the data breaches was that they were going to impose new higher penalties up to 50 million, or indeed it could be, I think, a third of revenue. So it could be very, very large. Now, we've said a couple of things about that. In the broad, yes, we think there is a case for higher penalties, but they need to be graded so that, for example, small businesses aren't exposed to the same big penalties. But we also need to think about the incentive effects, because it would be really bad if a new penalty regime lends weight to arguments that might occur within a business where some might say, oh, let's not report this to the Australian Cybersecurity Centre, to the Australian Signals Directorate, because of the penalties. That would be, so you've got to think about the incentives. We don't want there to be disincentives. I guess my broader point is it needs to be part of a bigger plan to deal with the issue of data breaches, which are unfortunately a reasonably common feature, or they have been over recent years, of the modern economy in Australia and elsewhere. So what do we do about that? I've called for a broader plan looking at the impacts on business. One of the issues here is a digital identity. Now,
surely that's got to be one of the great answers, that we don't need to go through driver's licences, passports, Medibank numbers, whatever it might be. Surely a better digital identity would be better for the nation as a whole.
It would be much better. So the idea is that you would have what's called a trusted digital identity provider. There would be several of those. You could make your choice. But let's assume you chose Services Australia. So you go through a one-time process, you establish your identity, draw on confidential tax office records, passport office, etc. Now, you turn up to open an account with CommBank or with Optus or anybody else. Instead of you handing over your driver's licence, your passport, a bunch of personal documents that they then keep on file, instead, your trusted digital identity provider, you get through them a one-time digital code. That authorises Optus to use their computer system to access the computer system of your trusted digital identity provider. It can certify, yes, Mr. Fletcher is who he says it is, who he says he is, but it can also do more. So imagine you're booking a car with Hertz. Hertz needs to know that you've got a licence, you're over 25 or whatever age they specify, that you haven't racked up more than 13 points, so your licence disqualified. That could all be digitally certified to Hertz without them ever having your driver's licence number. So this basic principle that if there's a trusted digital identity provider, that we all have one that we choose to use, it certifies digitally to the company you're establishing an account with. That's more efficient, but it also means that lots of companies no longer are holding all your personal information.
Except for one thing, and that is, given the digital economy, companies have now become used to the idea that they hold as much data as they can, for the idea that if somebody walks through a shop, they know that they've bought a pair of, blue pants, sort of 6 months ago or 8 months ago, and maybe they might be interested in another pair of blue pants. That's, if you like, the intuitive way in which retail and consumption is going to change into the future.
And that's where this idea is that this data, my data about me, your data about you, is commercially valuable. So we need to have a policy framework so that you or I can get benefit from our data. That's why we legislated the consumer data rights. So the idea is your patterns of repayment with whoever your mortgage is with, that's useful information to another bank. You ought to be able to authorise that information to be shared so that another bank can come to you and say, well, Mr. Greenwood, we can give you a better deal.
Which is open banking, which is open telecommunications and open utilities, gas, water, electricity.
Yes, so that's the idea. The consumer data right rolled out in banking at the moment, and some next steps are telecommunications and energy. And it's this fundamental idea, this data about your practices as a consumer is valuable. And again, it's part of the broader economic efficiency benefits that a digital economy can bring, that you as a consumer can leverage that data. You give consent as to who can use it, who can see it, and in turn, that means better deals are provided to you.
Okay, given the hack at Medibank in particular, my gut feel is that the hackers clearly had significant technology there. They've got a business plan, they've got incentive, they've got a lot of things. They clearly are highly sophisticated. The question is, have the hackers won?
I think this is an ongoing battle, and we absolutely should not concede or assume that the hackers have won. What we know is that there are governments that are involved in this around the world, and also criminal gangs. What we need to do is make sure that Australia is not seen as a soft target, as a honeypot. That requires action by businesses and their management teams, also action by government. And we do have great resources, and we put a lot of money. In fact, we committed almost $10 billion to strengthen the capacity of the Australian Signals Directorate. What I've argued for in the speech I gave earlier this week is that we need to have a broader plan that focuses on business, that looks at these issues like the take-up of trusted digital identity. We did a lot of work on that. In fact, we issued an exposure draft of a bill just before the end of last year that could establish the legal framework that would then allow private sector businesses to use what is now known as MyGov ID. So it already exists, but you can use it with federal government departments. The idea is, let's make that available to private sector businesses, or when you're dealing with state and local government, but we need that regulatory, that legal framework. So I'm certainly calling on the Albanese government to get on with it, progress with that legislation, because it could help establish that framework, and that could be part of an overall integrated plan to deal with cybersecurity issues. Now, another idea that I've put forward based on some consultations across the telco sector and the tech sector is we've got a lot of businesses that are still using old operating systems, Windows 7 or even earlier. Now, they're very vulnerable because Microsoft is no longer issuing patches and security upgrades. We ought to have some measures to encourage and incent business to upgrade if they're using old operating systems.
In other words, the instant asset write-off type of thing for them if they do upgrade to these newer systems. Paul Fletcher, good to chat to you. As always, many thanks for your time.
Thanks, Ross.
Coming up after the break, Volvo Australia has just received an order for 36 electric trucks. So how will they hold up in the Australian transport market, which is known for extreme weather conditions and long distances? I'll speak to Volvo next. Welcome back to Business Weekend. Volvo Group Australia is delivering 36 electric trucks to an Aussie client next year. But the big question is, why would a freight and postage company want to pivot towards using electric vehicles? A report released earlier this year by the Queensland Transport and Logistics Council estimates that electric trucks comprised just 0.5% of the market. So where does this leave manufacturers like Volvo? I spoke with the President and Chief Executive of its Australian operations, Martin Merrick, a little earlier.
We just took an order, announced it this week, for the world's largest order for Volvo medium-duty electric trucks, and that's to Team Global Express. It's for 36 FL Volvo battery electric vehicles running in the Sydney area. We see many companies now in Australia that really have a desire to decarbonise their fleet, and that journey has started. We anticipate by 2030, roughly 50% of the Volvo trucks we sell will be electric.
Yeah, just talk us through the sort of electric trucks Volvo currently offers. What's the range? You know, how much weight can they move for clients? That sort of thing.
Yeah. Good question, Ed. Our full Volvo range has been electrified, so we can offer diesel and electric today. So the full range that we have, there's 6 models, from the very light vehicle that you see behind me here to our heavy vehicles, it's prime movers that can have 44-tonne gross vehicle weight.
And say an entirely electric prime mover, how long would it take to charge up one of those trucks, and what sort of distances would it be able to cover on a single charge?
On a single charge, it's around 300 kilometres, and we can then have a fast charger, DC, 90 minutes, or overnight, which is between 6 and 9 hours, depending how low the battery charge is. So really effective for the majority of operations that we see, certainly around the main metropolitan areas of Australia.
So the whole idea is for sort of inner city metropolitan deliveries, that's your main sort of customer and target base?
Absolutely. We can see that it's a very diverse transport industry in Australia, so there'll be a blend of solutions. We can see around the metropolitan areas battery electric vehicles, but fuel cell electric vehicles will support that for longer and heavier distances. But we will still have the internal combustion engine for many, many years to come in Australia for the real heavy transportation, and that will be run on different fuels of the future, which is still to come.
So, yeah, is Team Global Express sort of getting on the front foot a bit here by ordering 36 of your vehicles?
Absolutely. So, again, we have many, many transport companies who are really looking to decarbonise our transports. They've got very ambitious sustainability targets, and we can support them. And we're first out here in Australia with heavy electric vehicles. You know, and I have to say, Team Global Express are off the mark now with 36, which will go into operation during 2023.
And then I guess the big question is the price point. How does an electric truck compare to a standard diesel truck that you manufacture?
Well, the initial outlay is more expensive, but during operations, the total cost of ownership, i.e. running costs and parts usage, will get paid back over time. So the initial outlay is certainly more expensive, and over time, as we see the adoption rate increasing, the initial cost will come down over time.
Yeah, and as that adoption rate goes up, just how tight is the competition now becoming in that electrified transport market?
Well, we can see it globally, it's happening, and actually here in Australia. And I have to say, we really welcome that competition, because if we don't have that competition, we will take too long to actually decarbonise the transport industry.
And how difficult a challenge is it going to be to get these big transport companies to shift their thinking to move towards the electric? Because I know we've got the phrase here, without trucks, Australia stops, and a lot of Aussie transport companies would still be running those huge diesel-powered prime movers. So is there going to need to be a bit of a shift in cultural thinking here to get the electric trucks over the line?
Yeah, absolutely, Ed. And that's already started. We've taken customers over to Sweden to drive the heavy-duty battery electric vehicles, and already we can feel once you've actually driven one, you don't want to go back. So, of course, certain segments will still require internal combustion engines, but the majority of transport that we see around the metropolitan areas, we see a shift in mindset and also the desire from these companies to take on electric vehicles.
Yeah, and I know the big diesel prime movers can be restricted from driving on certain roads around the country. Are there similar sorts of regulations in Australia for the electric trucks as well?
At the moment, we have the vehicle behind us can actually operate in Australia within the legislation. But into next year, as we want to introduce heavy-duty battery electric vehicles, we need legislation change. So we really need all levels of government to work together, to collaborate, to ensure that we actually accelerate this transition. So we really need legislation change, Ed.
Yeah, I know you had a press conference with Chris Bowen, one of the big ministers in the government this week. What's the reception been from the government towards this shift towards electric vehicles?
Well, what I'm hearing, particularly from the National Heavy Vehicle Regulator, is there's a real desire for government to get together to accelerate this legislation change. They know what's required for us to then really increase the adoption rate. So from what I've heard, there's a real desire to do that. How long it will take, that's still to be seen.
And Martin, as a chief executive, how do you assess the strength of Australia's economy right now, and how big a challenge has rising inflation been for you?
At the moment, we're not seeing a real impact. The demand from the transport industry is still very high, but overall, of course, we keep a very close eye on the economic conditions. But we see Australia at the moment still performing very well overall, compared perhaps to what we see in Europe and overseas right now. And as I say, our customers' demand is extremely high at the moment. So we keep a close eye on it. We make sure we're agile, but at the moment, it's still we're moving ahead quickly and strongly in Australia.
Yeah, I saw the recent car sales figures for November showing almost 1 million vehicles have been sold. New vehicles have been sold this year. So it looks like demand for new vehicles is still pretty strong.
Absolutely. If we take the truck market, the heavy-duty truck market this year in Australia will be a record. It'll be over 14,000, maybe 14,500. Doesn't sound a lot compared to cars, but that's a very strong market. The last peak in high market was 2018. And we can see that going forward, 2023 is still very strong at the moment. So as I've said, that it's a high demand and it's a strong market that we can see going forward.
Well, Martin Merrick, President and Chief Executive, Volvo Group Australia, thanks for your time today.
Thanks very much, Ed.
Artificial intelligence is getting more and more sophisticated. And just in the past week, a company called OpenAI launched a chatbot which you can throw any question at and it'll come back to you with a pretty thoughtful answer. Well, look, joining me now on the set is Rick McConnell, the Chief Executive at software intelligence company Dynatrace. Rick, thanks for your time. First up, I just want to quickly talk about OpenAI, this chatbot that launched this week. Is this sort of intelligence program sort of becoming the future of where AI tech is heading?
Well, digital transformation is ubiquitous. It has exploded in cloud deployment, cloud migration. This is resulting in an enormous amount of data and an increase in complexity. The result of that is it's very hard to construct software that works perfectly if you have to manually manage it. And so automation is everything. And AI Ops is really the foundation of that.
Yeah, just talk to me about Dynatrace, how it uses artificial intelligence software.
Well, we compile all of this data, traces, routes, real user data. We compile it all together in context. And by keeping it in context, we are focused on getting to answers. The AI Ops engine that we've built enables us to do that by compiling all that information and evaluating it together. And that really results in software that is designed to work perfectly.
So what are some things that your clients really want to achieve using Dynatrace? What are they telling you they need?
They simply want a perfectly operating software environment. We have all gotten used to, as end users, software that has to work all the time. My observation is we've lost patience. And if an app isn't working on your mobile device or on your PC or laptop, you simply look to go elsewhere. Companies can't afford that. They have to have software that works the way that end users expect it to work with an exceptional user experience. And to do that, you need automated tools, which is enabled through AI Ops to essentially enable companies to have their software work much better than it otherwise would.
And how much demand is there right now for what sort of stuff you guys are providing?
Enormous demand. It's interesting, even in an environment of macro slowdown, what we see is that organizations have to get more efficient with resources. And that efficiency comes with automation. And AI Ops is one enabler of that automation.
How tough is it right now to innovate in your sector and come up with all these sorts of new ideas and new ways of doing things?
We just released a brand new platform called Grail. It's very exciting, very large data lakehouse, massively parallel processing data lakehouse. And so we're innovating at a very rapid rate. And I think that the observability market, which is really the market that we're part of, has a lot of runway left to go.
US economy looks like it's heading to recession next year. What does that mean for tech companies and the tech sector in America? Are you feeling a bit of pressure at the moment?
Well, I think all software companies are feeling a little bit of pressure, especially if you're in the SMB space. Now, we're oriented to the enterprise, which is a little bit more resilient, but sure, there's pressure in the sense of delayed deals, deferred purchases, those sorts of things from some sectors in particular. The result of it, though, at the end of the day, is that the fundamentals of our market are very, very strong. Digital transformation is growing. It's leading to increased efficiency. It's leading to more rapid product development. And again, it is requiring this degree of automation that you and I have been talking about.
And as interest rates have been going up, is that pushing up your cost of capital or tapping investors for funding? Is it having any impact there?
I think for those organizations that are reliant upon capital to make additional purchases, they're the ones that are somewhat constrained. And perhaps that's part of the driver of some delay or deferral in some of the purchasing decisions. But generally speaking, the overwhelming desire to digitally transform businesses and get on the cloud and enable that environment to deliver faster automation, better product development, improved efficiency of supply chain is winning out over the deferral of budgets.
And having access to so much data can come with risks. Like in Australia recently, we've seen a big health insurer, Medibank, its data's been hacked and customer records have been put out on the internet. Same with a telco here called Optus. I mean, how critical is it to have your systems totally locked down?
Well, it's critical to make sure that you have things like zero-day response to such threats and such threat vectors. And we participate in that application security market as well, because having such a detailed position inside your software ecosystem enables us to see things earlier. So our AppSec solutions associated with things like vulnerability management become really critical for organizations to manage against going forward.
Yeah, some of these big companies like Medibank have talked about how they might be attacked thousands of times every single day. I mean, what's your experiences at Dynatrace?
Absolutely the case. And before Dynatrace, I was at a company with Akamai, and we saw the same thing. Organizations are getting attacked all the time. And the result of that is you have to have resilience 24/7.
What's the vibe like right now in the US tech sector? There's been some big stories recently with Elon Musk buying Twitter, making some big changes there, and then Meta at the same time cutting thousands of staff. So what's the sort of vibe like at the moment?
It depends on the sector. It depends on the type of company. At Dynatrace, we are very much focused on delivering a balanced business. We believe that the environment for growth at all cost is gone, at least for the time being. The orientation of investors, certainly our investors, customers as well, is they want to be investing with companies that have a balanced growth model. That's what we deliver. We're delivering mid-20s or higher overall revenue growth with mid-20s operating margin. That sort of balanced approach with high cash flow is enabling us to build a very stable company.
And just quickly, what's your sort of place in the Australian market?
I just left our office with a very, very solid and significant number of people there. We have a strong and growing position in the Australian market that is enabling all these capabilities to exist here in this market as well.
Well, Rick McConnell, Chief Executive at Dynatrace, thanks so much for joining us on the show.
Thanks so much, Ed. Appreciate being here.
After the break, the La Nina weather pattern has brought record amounts of rain to Australia, which has resulted in bumper seasons for Aussie farmers. We speak to government agricultural research group ABARES next. Thanks for being with us on Business Weekend. La Nina has brought record rainfall to parts of Australia this year, and it's been a huge boost for the agriculture sector. But that rain has also increased the amount of flooding, causing extensive damage to vast parts of the country. Joining me now is Dr. Jared Greenville, the Executive Director at ABARES. Jared, thanks so much for your time today. It looks like the gross value of Australia's agricultural production is going to be near a record again in this new financial year. How much of that is simply due to all the rainfall that we're having?
Thanks for having me along. So gross record, another record for our gross value of production this year, or close to, around $85 billion. And a large part of that's been about the weather that we've received. And so there's a bit of variation across the country, as you mentioned, with flooding, particularly in New South Wales and Victoria. But out of the West and Western Australia, they've had close to ideal growing conditions this year and set to hit a record winter crop. That's kind of flowed through to South Australia, which is also hitting records. Those two states are really carrying the difference that we've seen in New South Wales and helping us contribute to that total. For producers who are not underwater, so who have avoided the floods, they've also had some pretty good year, and we're expecting kind of higher yields than what we would otherwise see.
Yeah, we've got a chart we can put up on the screen showing the value of production compared to exports. And it really looks like the value of exports has been rising a lot faster than the value of Australia's farm production. Is there any sort of specific type of crop that's really jumped up in price significantly this year?
Yeah, we've seen kind of jumps in prices over the last couple of years, or yet last year and this year, because of the war in Ukraine, and that's really affected both wheat, barley, but also our oilseeds, and in our case it's canola. And there's a combination of the war in Ukraine for the grains, and for canola it was due to poor seasonal conditions that are occurring elsewhere in the world. They've come off a little bit as those seasonal conditions have improved a little bit, but that's led to really those kind of high prices for our grain side of the market. We're still experiencing some quite high prices compared to the history in our livestock sectors, so for red meat in particular, but they've come down a lot as global supplies have improved and China's demand's dropped off as their pig herd and domestic production's increased.
Yeah, there's actually a report from the ACCC this week looking at bulk grain handling, showing grain shipments hit 40.6 million tonnes in the most recent financial year. So is the grain sector really still going to be booming for the next 12 months at least?
Yeah, it is. So consecutive really large record crops will mean that shipping that grain will take more than just a few months. And when we look at the amount of grain that's been going out, we're hitting record levels. We're also hitting record value in terms of the export value that goes out in those grains. But because we've had now really 3 good years of production, that means that there's still a lot of grain that's held, in Australia and on farm and which has to move. And that's sometimes the amount of supply versus our export capacity has led to a little bit of a differences in prices in some areas between what producers receive and what's going out at the export terminal. But we expect as the season kind of goes along that some of those hold-ups should hopefully start to ease. And if we can maintain this kind of pace, we should be able to export, quite a bit over the next year.
And obviously that rainfall has also brought significant floods for a lot of the east coast of Australia. Just how damaging have the floods this year been for farmers in agriculture?
Yeah, so the widespread nature of the flooding is really quite remarkable this year, and we saw flooding at the end of last year as well, but it didn't affect, I guess, such a great region of the country. So this year around 50% of agricultural production occurs in regions which are experiencing flooding. That's translated to around 16% of the crop area that was planted in New South Wales being wiped out because of floods. We've got smaller rates in other states, so around 7% of planted area in Victoria had to be abandoned because of the floods, and around 5% in Queensland. In Queensland and Victoria, we've got some offsetting impacts from higher yields in some places which weren't flooding. But in New South Wales, we've downgraded our expectation for the forecast for the winter crop production by around 2 million tonnes. So that's really quite significant.
Yeah, I know your estimate for the flood damage in 2011-2012 was about $500 to $600 million in lost crops. Do you think the floods this time around are worse than the 2011-2012 floods?
Certainly the value of the crop is much higher this time round. So we kind of had a look at just the impact on New South Wales, and we would estimate that around, if that was to be taken through, and it's a bit hard sometimes to know exactly what quality that production would have been if it made it through the season, but it could have been about $900 million, we estimate, in terms of the write-down in terms of the overall production value out of New South Wales. So that is quite a significant number. Some of the other impacts, it's too early to tell, so particularly with waterlogging and the fact that the harvest is quite delayed as we get down into the southern states. So we don't know the true impact, but then you've got the positive side of higher yields in some areas and higher returns. And so it's a bit hard to kind of say that floods or the weather systems per se have led to a certain impact. But we know for sure for New South Wales that for those people who've lost out, it's a significant loss.
And putting the floods aside to 1 second, in broad terms though, are farmers in a pretty good place financially this year?
Yeah, we saw record profits levels across the country for most producers last year, and while we've got a fairly significant increase in fertiliser and fuel prices for this growing season, the high prices at the commodity end, at the output end, have really been maintained. So for those producers who have managed to get a crop in and get it out, although profits won't be as high and incomes won't be as high as last year, we're still expecting them to be strong, particularly when we compare to the historical average. So still a pretty good year overall for the farmers themselves.
And it also just quickly looks like it could be another wet summer. So what does that mean for the farm sector?
Yeah, the wet summers will really impact what we do for our summer cropping season, and also for some of the harvests, particularly for horticulture, as that water really moves down the Murray River. So we're expecting it to have quite significant impacts on our rice and cotton production. And so with the area that's planted, say for rice, around 50% down on what it was last year, and for cotton around 40% lower, and that will flow through to lower production later on in the year. So they're the main sectors that we're expecting to be impacted. The flooding and continued kind of wet conditions are also likely to play a bit of havoc in terms of moving grain and other things out of the country, or even into horticultural products into supermarkets and so forth. And so that will have a bit of a pressure point when it comes to prices for some particular commodities, for us as consumers when we go to the supermarket. But we expect supplies overall to be strong.
Dr. Jared Greenville from ABARES, thanks so much for your time today.
My pleasure. Thanks for having me along.
Small and medium-sized businesses have dealt with plenty of challenges this year: inflation, interest rates, skill shortages, and just general economic uncertainty. The big question is, how are business owners feeling as we head into Christmas? I caught up with the Chief Executive of business lender MoneyTech, Nick McGrath, a little earlier.
I think they've got plenty to worry about, but also a lot of silver lining as well. So a lot of our borrowers at the moment are talking to us obviously about interest rates and inflation, but broadly supply chain issues are starting to loosen up. So coming up into the Christmas period, obviously inflation and interest rates are a hot topic, but there are some good times on the horizon as well in terms of supply chain disruption coming to an end, or at least partially coming to an end.
Yeah, so supply chain disruptions slowly starting to ease off. So what would that mean for a small business operator?
It means a lot for a small business operator. So whether they're buying domestically in Australia or they're importing themselves, a good thing for a small business operator is that they've got access to goods. The reality is, over the last couple of years with COVID disruption, they've had major issues with accessing material. If you look at the building and construction industry, for example, timber rates, steel costs, they're through the roof. So that industry in particular has had a really hard time, as have many. But with things easing off, hopefully a lot of our borrowers and a lot of SMEs and small businesses will see, a reduction in inflation and sort of a return to normality in terms of being able to access inventory and stock, whether they're buying domestically or from overseas.
Yeah, just how challenging a year do you think it's been for small businesses? I know insolvencies have unfortunately been on the rise for the last 12 months.
Yeah, well, interestingly with insolvency, we're still below pre-COVID levels. So in terms of businesses being wound up, it's still at pre-COVID levels, but during COVID, insolvency rates were at historical lows, predominantly because the ATO at that point in time was not taking a lot of enforcement action around ATO arrears that had accrued with SMEs or small business over that period. The ATO does seem to be acting a little bit more in line with pre-COVID levels. That being said, I believe that sort of pre-COVID times, the ATO were looking at winding up circa 2,000 businesses per annum based on ATO arrears. It's well below that at the moment. So whilst insolvency rates are increasing with the cessation of JobKeeper and various other government grants and incentives, it's still well below pre-COVID levels, and they seem to be faring pretty well at the moment, Ed.
And look, just in the last couple of weeks, there's been some changes to Australia's industrial relations laws, which is putting multi-employer bargaining on the table. Have any businesses you've spoken to flagged any concerns with these new changes to IR?
Yeah, look, MoneyTech looks after a whole range of businesses with turnover from anywhere from 100,000 per annum up to ASX listed businesses turning over 300 or 400 million per annum. So depending on the size of the business, we are getting different feedback on the IR laws. Some are pro the changes, some are anti the changes, but I think broadly speaking, it's been reasonably well received.
Yeah, and from your perspective, are businesses right now still confident enough to invest and make big investment decisions?
Well, interestingly, depending on what market you look at, if you look at the fintech space or the technology space, there's mass layoffs across the board, whether it's from fintech lending through to crypto and various other industries. So I think there is a fair bit of hesitation around employing staff. And the reality is during COVID, it was very difficult to get workers, whether that was white collar or blue collar labour hire. It was incredibly difficult. So the job market during COVID for people that were onshore here in Australia was fantastic. What we have seen though, and what we are hearing from a lot of our businesses that we lend money to at the moment, is that they are either trying to retain a flat workforce or reduce their workforce. So I do think that that labour market shortage is going to ease up over time, particularly over the next 6 to 12 months as rates rise and inflation rises and businesses are looking at ways to cut costs.
Yeah, I know you guys provide about $2.5 billion in financing each year. How much demand are you experiencing at the moment?
What we'd seen sort of, I guess, at the start of COVID, we saw a big drop-off in terms of demand for credit. Borrowers were very hesitant. At that point in time, they were very comfortable to stay with their incumbent lender without making, a rash decision. They wanted to see what was going to happen. Then as the COVID bubble burst and businesses were able to continue operating, depending on the size in the industry, we've seen a 15% demand in credit growth. We are expecting, though, given rising interest rates and inflation, to see that drop to sort of 3 to 5% per annum in credit growth moving forward. So the market had been good, but the reality is right now, with rates rising and inflation, business sentiment or credit growth is certainly slowing, and we've seen that over the last few months with our clients.
Well, Nick McGrath, Chief Executive at MoneyTech, thanks so much for your time today.
Thanks, Ed. Appreciate your time.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up with all the latest business news with our daily program, Business Now, at 4:30 and 11:30 p.m. Eastern Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.